All right. Welcome to lecture three. How's everyone doing? Good. All right. Just want to wish those that who are Chinese prosperous New Year. And thanks for coming. I know I received a couple of emails saying that some of your classmates will not be joining us today because they do have some reunion and celebration for Chinese New Year. So maybe we'll just start. I don't think we'll have a full attendance today. Okay. So for today, what we're doing is we are almost midway through. So after today's lecture, we are midway through the module. I would say that um, from lecture 3 and 4 at least, it might be slightly lighter. You'll feel the content is not too heavy, even though we'll cover some new concepts. Um, and then from 5 and 6, then it'll be a totally different uh, kind of lecture because 5 and 6 we're doing relative valuation and technical analysis. Right? Before we start the lecture, so next week will be your class test. Do we have any questions regarding the class test? Okay, maybe not at the moment. But if you later ask this again, it's online. You're right. So it's online. You can do it at your own, not at your own time, but at your own location. So you do not need to be in school, um, to be in a specific room to do your class test. So you can do it at home. Um, the main thing is just to ensure that you have good internet connection. So you'll be covering lecture 1 and 2. In the last two lectures, we mentioned that for the qualitative questions, the chances are coming from lecture 1. The quantitative questions are typically coming from lecture 2. In terms of practice questions, even though lecture 1 and 2 do not really have any so-called self-review questions, in case you want to practice some quantitative questions, you can refer to lecture 3 and 4. So recall that lecture 2, it's a bit of an overview of the various methods. So for lecture 3, you'll notice at the back of the slides, there are quite a lot of practice questions. So they might not be exactly what is being tested in the sense because lecture 3 covers a lot more, but then it goes through the concept of the dividend discount model and some basic calculations. So if you really want to do some practice, you can look at those examples. Yeah. Uh, 28. Yes, it's 28. 28 is next week, right? Yeah, it's next week.
Rob, isn't it on 28 March? The announcement says 28 March.
Oh, it's 28 March.
Yeah,
Oh, thank you. Let me just check again. Feb or March? Actually, good question. Thanks for highlighting that. Let me just check. Uh, oh yeah, you're right. It's 28 March, which is actually quite late for class test actually. That's strange. Just 1 week before the end of lecture. Okay, sorry, sorry for to scare any of y'all. Um, yeah, so it's lecture 1 and 2, lesson 1 and 2. You're right. So okay, I didn't notice that it was 28 March because normally it's somewhere in between the semester the lecture. So lecture three is typically where usually the week after that will be a class test. Yeah, but it seems like they push it all the way back, which is strange because then they are going the coverage is only lecture one and two, right? So it's a bit strange, but I guess it's okay. Then then yeah, I guess it's better because we'll have covered lecture three and lecture four, meaning that you can practice some of the self-review questions in the back, and they'll be useful for your class test. So for the questions, there are normally what happened the previous semester is that there's a mix, so there's MCQ and the tag-out questions. So there's usually a mix. Okay. Okay, so let's start the lecture today. So today, what we're going to do is we're going to divide the lecture in two parts. So we'll cover the lecture slides. That's the first part. I think we'll roughly take around 2 hours for that. And then for the last hour, what we'll do is we'll cover the Nike case. So recall that I think the last lecture I mentioned that when if I have time, or when I have time in the next few lectures, I'll do the cases. So I think in this lecture we do have most likely an hour slot where we'll cover the Nike case, and I'll go through with you some of the parameters of the case, what is important to take note, because the Nike case would be important for your GPA, as it look at how you take data from the various platforms and what kind of data you should look at or what kind of assumptions you should consider, right? So that's what we're going to cover. So two parts, the lecture proper, and then we go to the case study. All right. So so today's lecture we're going to focus on the dividend discount model. So purely dividend discount model, not the free cash flow model. And arguably, I think the dividend discount model is the simplest of them, right? Simplest of the four models that we discussed last week. So the dividend discount model, we look at was dividends, right? So when you look at dividends might have various growth stages, right? So whether the dividends are in a high, whether the company is a high growth stage, where in this case there might be lesser dividends that's being paid out because they are imagine like a startup, right? A startup. So they typically want to reinvest their funds, so they do not really pay dividends. So dividends is low. Revenue growth might be very high, but because of some investment needs, because they're like a startup, so they will not typically pay dividends in that sense. The risk level is high at that in this stage of their growth. Um, Normally the high growth stage do not really last that long, right? So they last only 3 to 5 years, and eventually they'll transition to more of the normal growth. And so when they're at the normal growth, that's where the growth rate would decrease to a normal rate. And this would be dependent on things like barriers to entry, which we kind of like discussed in lecture one. And because of that, there's less investments required. So investment need is lower. And so the company can actually pay the free cash as dividends. So there will be higher dividends being paid. Right, so most companies are in this normal growth stage. And then we have this last stage called no growth, right? So this no growth stage, I would say that in real life, um, they do not really, it doesn't really occur in reality, right? So this no growth, it's really more of a theoretical kind of stage because if a company does not grow, means that it's in decline, means that eventually it will close, right? It will be sold off or you will no longer continue operation, right? So a company will not really stay in the no growth stage. And in no growth, what we are saying is that it means there's no growth in revenue, right? So imagine your company has 100 million of revenue, every year is going 100 million for next till eternity. And this is very uh, unrealistic because there's inflation. If you have 100 million all year round, meaning that your earnings are actually reducing, right? So this no growth this is purely theoretical, but in the sense that if a company is in this no growth stage, meaning that revenue will not grow, there's no need for further investment. Um, this is the important part. Company pay all its earnings in dividends, right? Because they're not growing, so meaning that everything they have will be paid as dividends, and the risk level will be reduced from the normal growth to no growth, meaning that no growth, of course, is the lowest risk, right? So important thing to take note is that if a question do prompt you that, hey, you know what, this company is in a no growth stage, we need to be able to know that the no growth stage characteristics is that all the earnings is being paid as dividends. Okay, so 100%. And I think I'll highlight this to you in the subsequent slide again, because this is an important characteristics. So summary here, risk level, no growth, the lowest, uh, high growth, the highest. And for dividends policy, because we are doing the dividend discount model, no growth is 100% payout, right? And this is by default based on the growth stages. So some the growth development in terms of the company, we see that at this point when it's developing, meaning high growth, there's no cash dividend payout. As it goes up in the growth stage, maybe there's a bit of a low dividends. Then it becomes more of the mature stage where the dividends will be higher, moderate to high, and mature state will be high, right? Um, and like what we discussed earlier, normally the company will either go in the decline or continue to grow at a steady pace, but will not be a flat no growth, right? Flat is no growth like this, very unlikely. So it will either be a decline here or just a steady upwards. Thanks for the question. Yeah, that's good. So how we have to think about a high growth stage, right? So a high growth stage is somewhere here, right? High, the growth is very high. So at this stage, imagine like a startup. So in a startup, right, you know that the startup can either do very well, right? They have a new product, they do very well, or they can fail, right? So there is two extremes. And because of that, there is very high risk for such a company that is in a high growth startup kind of phase, right? So yes, the revenue might be increasing a lot, but remember that the revenue is very small, right? So imagine a startup. So maybe the revenue start off with 1 million. Next year is 2 million. So 1 to 2 million is 100% jump. It's a lot, right? The growth is a lot. But it might not be a lot compared to, let's say, a very mature company from 100 million to let's say 200 million. So even though it's the same 100% increase, but it's a whole 100 million increase, right? So that's how you can see about it. And because of imagine because it's like a startup, a lot of these funds that they get from increase in revenue will have to reinvested to, let's say, improve the product, um, maybe to hire more people so they can expand operations, right? So a lot of these will have reinvested, which is why we mentioned the thing of high investments, right? They need to invest. Okay, yeah, thanks for the question. So the best way to think about it is high growth, it's like a startup. Yes, so in terms of investor expectations too, you're right. So normally for startup, who invest in startup? So they are typically like hedge funds, angel investors, um, venture capitalists. So these investors are investors that know that the kind of investment they are making is very high risk, and therefore they factor this into their investment, right? So you will not see like a bank kind of investing in a startup, right? It is very unlikely. When you go to the market, what you see is always, oh, it's a venture cap. It is maybe a certain kind of fund, right? A fund that is owned by a sovereign company or sovereign entity, right? Or maybe it's a venture capitalist. Yeah. So very different kind of profile in terms of risk. For high growth, like a startup company versus like a normal growth kind of mature company. Okay. Okay. So in terms of the type of dividend discount model, broad overview. So before we go to the details and nitty-gritty, right? There are three types that we're going to focus on, right? So the first type of dividend discount model is arguably the simplest, where we just say it's a single stage model. So a single stage model means that there's not going to be any change in growth. So a company will either not grow meaning if I plot the graph of growth in the y-axis and time, it will just be a flat line, the flat red line as you can see here, right? The flat red line. So no growth, right? Growth is zero. Or it can be growing at a normal, stable growth rate, meaning that the growth rate would just be maybe 10%. So like 10% forever, right? So it's stable growth. Okay, so this is the first type. We'll go in the details in just a bit. So this is just an overview slide, right? The second type of dividend discount model is a two-stage. So two-stage meaning that there is a stage where the growth is we call it typically call it GS, which is growth supernatural, meaning supernatural growth at very high growth at high growth stage, and then it will suddenly drop into this GL, right? I call it GL, which is growth long term. So it just as a stable long term growth rate. So in a two stage, the first type, which is a simple two stage, will have this sudden drop from GS to GL. Now, in a two stage, we also can look at something that is more linear decline, right? Which is a bit more realistic because the company's growth do not just drop overnight from GS to GL, right? So this is a two-stage H model, quite H model, H model, where there is going to be a linear decline from GS to GL here. Okay. Again, this is an overview, so we'll go into details in just a bit. Right? So we have covered the one stage, two stage, and now the three stage. So the three stage model, I don't know whether it's fortunate or unfortunate, is not in our syllabus, right? So for those of you all who are interested to take the CFA, this is in the curriculum, but for the purpose of this course, the three stage is not part of the syllabus. However, I just want to highlight to you that even for the three stage model, it's not complex, right? And how we can see a three-stage model is this, right? There's going to be either the first one where the middle stage is going to be constant, like this here, or the middle stage will have a decline, right? Therefore, we can see that if it's the first part, this component here is like your H model, right? And if it's the second scenario, this one, the decline and flat is like your H model. Okay. So it's for the three-stage A and three-stage B, it really just depends on where the decline happens, right? And so that decline is the H model. And in the next slide, we can see that where is the H model, right? So in this form, where there's a decline in the middle, that is your This one, your B, right? Your B. That means there's a decline here, which is congruent to this H model here, right? There's a transition stage. Now, if it's the other way around, which is the three-stage A, then your H model will be on the top first, um, followed by a decline later, right? Just for you to understand that there's such thing as a H model, but it's not in our syllabus for the purpose of this course. Any questions? I guess we're good. Okay, so let's now go into detail, right? So earlier was just an overview of the three models. The first single stage, double stage, and the three-stage model. So we'll just focus on the single stage and double stage, and we'll go into details of those. Okay, for the single stage model, um, let's tackle the first situation where there's no growth, meaning that the growth rate is going to be zero, right? So again, I highlight growth rate zero, meaning that if we plot the growth as the y-axis, time as the x-axis, your growth is basically the red line here, which is zero. Okay, so this happen when the company is not growing, right? So, and pays out 100% of this ratio, 100% of its revenue as dividend. So I'm just going to feed back to you. Maybe it's a bit of a broken record, but this is where we are at here, right? No growth, 100%. So hope you can see the link between what we covered at the first slide of today's lecture on the three growth stage. And now we jump back to the first model that we look at, which is the no growth, meaning that 100% will be paid out, right? So a question can come up where they just say this company is in a no growth stage and then explain to you all the situation, not telling you about the payout ratio. So it's assumed that you need to know the payout ratio is 100% for such a case. Okay, so all earnings are paid out as dividends, and amount of dividends will be the same for all, right? Because no growth, so it's just going to be flat. Meaning if the company is going to pay out 10 million of dividends, it's going to be 10 million forever. And when we think about forever, right? If it's a standard same payment forever, same cash flow forever, it, to calculate this is basically just the present value of the perpetuity, right? Because and perpetuity is a stream of cash flow or a stream of the same cash flow forever. Okay, so we use this present value formula equals to the cash flow divided by the discount rate. Important thing to take note here is this, right? The cash flow is always the first payment one period from today. Okay, so one period from today, right? So it's not the uh, cash flow at time zero. So let me just emphasize this again. So let's draw a timeline here, right? 0, 1, sorry, 2, 3, 4, right? So suppose I say that, oh, you know what? This company is going to start its no growth stage in year, let's say year 3. So from year 3, it's going to be no growth already, right? But now it's year 0, obviously. Now it's not, right? Year 0. So from year 3 onwards, meaning from here onwards, it's going to be no growth, meaning that it's going to get C, C. So you'll just keep on getting the cash flow C, right? Flat all the way. Now, with that in mind, then to use this present value of perpetuity formula, your formula will be based on here, right? So that means if you want to use this formula, C divided by R, your C divided by R is as of year 2. Does everyone understand this? Because it's the first period is one period from now, right? So that means if year 3 is the year that they have no growth, means that the present value of this perpetuity will be in year 2. And then from here, you will need to discount it 1, 2, because it's now, right? So you need to discount this value divided by 1 plus R squared, right? You need to discount the cash flow to 2 years down to now. Anyone need me to repeat this? Everyone gets this? So this is an important concept. So this is quite important. You need to know where the cash flow is at based on this formula, where the present value of perpetuity is starts one period from now. And if the no growth starts in year 3, where you get C from year 3 onwards, all the way to forever, then your PV formula here would be as of year 2 here. And yes, you have calculated the present value of perpetuity, but you do not stop there. You have to discount it by 2 years back down because it's as of year 2. Yes. Yeah. So it starts from 1 year before the cash flow starts, right? So it starts one period from now. Yeah, right. And then you still have to discount it back. Okay. Questions? Okay. Yeah. Okay, if no questions. So in the case of a no growth, when we think about the returns, right? The returns of a stock is based on two components. The returns on a stock is based on the dividend, which is what we're talking about, the dividend discount model, and the capital yield gain. Now, in the case where there's no growth, it means that all the returns is just going to be on the dividend yield, and it means that capital gain is zero. Okay, it's just a concept for you to know. Okay. Now, in the case of a stable growth, so now, okay, so just now we're talking about no growth, right? Now we're going to stable growth. So stable growth means that the growth is going to be flipped. It's going to stay constant, right? So in this case, I plot the growth on the y-axis against t. Your growth is going to be stable, and let's say it's 10%, right? So it's going to be 10% forever. Now, when it's a stable growth, the assumption is that the payout ratio is going to be constant throughout time, right? So amount of payout ratio. So payout ratio can be 50% uh, uh, of your revenue or your free cash will be paid out as dividend. So your 50% is going to be stable throughout. So your payout ratio typically less than 100% because 100% means no growth, right? And so it means that because you are growing at a stable rate, your dividends payout in terms of the value of it, the quantum, is also going to increase over time, right? Because you are growing at 10%, meaning that your payout quantum or payout amount is going to increase by 10% every year as well. And because of this increasing, growing stream of cash flow, we therefore use the present value of the growing perpetuity, right? So earlier, when there's no growth, we use the perpetuity, present value of perpetuity. Now is a growing perpetuity, right? So this is a bit of a recap of lecture 1, time value of money. component where there was a self-review part. So in a growing perpetuity, what we see is that the growing perpetuity formula basically is this, right? The dividends in year one, right? Meaning dividends in year zero times the one plus growth, because we want dividends in year one, divided by R minus G. So it's very similar to your perpetuity, right? Other than the fact there's a G here. So recall this time the perpetuity as well. It was C divided by R, right? Where C is the cash flow in year one. So same thing. This one is the dividend in year one divided by R minus G. Because you have a growth factor here, you have a minus G. Now, in this formula, the assumption is that your G must be less than R. If not, you'll get a negative discount rate, which means the model doesn't work, right? So that's the assumption that is required. So we see here that the dividends is one period from now. So same thing as what we talked about here, right? The cash flow has to be one period from today. Now, then the question is, okay, we know that it's going to grow at a steady pace of G, right? Then the question is, how do I determine G? So we did mention this in lecture 2 on how we calculate the sustainable growth rate, but I will re-emphasize this again, as well as bringing some additional information, right? So a sustainable growth rate is a growth rate where the company can grow without using external financing, meaning that they are not going to issue more shares, they are not going to take on more debt, right? So basically using the internal cash flow to grow the company. So it's only funds raised from the operations to grow the company. Now, the sustainable growth rate can be determined by three ways. First, you can use the historical data. So look at the historical growth rate, and then from there you can determine the sustainable growth. You can think of you can use the analyst forecast as well. So analyst forecast would typically use some historical value. Then they might do some adjustments to the forecast before they provide the sustainable growth rate to investors to use. Last but not least, they can use fundamentals, which is what in our module we typically focus on, right? The fundamentals, and this will be used, for your GPA as well, right? So in your GPA, when you calculate your sustainable growth rate, you will typically use these fundamentals, or you can use a mix, right? So again, remember this module is giving you different tools, right? So you can use both historical growth and the sustainable growth rate, and you can say, oh, I want to do an average, maybe a weighted average or a simple average, and you provide some justifications, right? So there are three different methods. It's up to you what to use. Typically, most of you all would use this sustainable growth rate fundamentals to calculate. Anyone can recall what's the formula? You can type it out or you can unmute yourself. So what's the formula for sustainable growth rate? ROE, yeah, times retention ratio. Yeah, you're right. RE times retention ratio. Teamwork, right? Teamwork makes the dream work. So one person say this, the other person say that. Yeah, right. So RE times retention ratio. Okay. So in this formula, right, where we use the fundamentals of ROE times retention ratio, there are very strong assumptions, right? So the first assumption is that profit margin is constant. There's not going to be a drastic change in the leverage policy, right? And there's going to be a stable dividend policy, right? Why Why do we say that? Because imagine your dividend policy keep changing, your retention ratio keeps changing, right? So what you can even do, right? If you notice that there's going to be a lot of changes in terms of the dividend policy, is that you can calculate the sustainable growth rate on a yearly basis, or maybe even on a quarter, not quarterly, but maybe every 3 years, and then you do the average, right? The average sustainable growth rate. You can do that as well. If you notice that the dividend payout is quite is fluctuating quite a lot. Of course, if you do notice that the dividend payout fluctuates too much, maybe the dividend discount model is not the right model. Recall in lecture two, we had 2 slides or 3 slides saying when it's good to use the dividend discount model, when you must be a bit careful. So in a situation where you see that the dividend policy changes quite a bit, then maybe you should use the free cash flow model, which is what we're going to talk next week in detail. Right. So just be careful on this. Okay, so in terms of this sustainable growth rate, let's say, right, the growth rate of company G is more, so the growth rate of company G is more than the optimal, right? So this is now optimal sustainable growth rate. Means that the company, right, is growing faster than the optimal growth, right? Imagine the company is growing super fast, but actually the optimal growth is much lower. In this situation, the company might find themselves in cash flow problems, right? Because they are growing faster than optimal. What they can do is to first go for external financing so they can get more cash from the market through debt or equity. So they can go to the market for more cash. What they can do is also to prune away some marginal activities, right? What does this mean? It means that you want to lower the growth. You remove some activities that you feel that actually is not the core activity of the company and only concentrate on the core activities. So in this sense, by removing certain business lines, certain segments, your growth of the company would slow down. Alternatively, you can outsource some of your production and possible lower costs. So by doing so, right, think about your ROE. So that's why I asked the question, how do you calculate sustainable growth rate? Is ROE times retention ratio, right? So when you outsource certain production, your ROE will increase. So in this sense, right, this comment here is going to increase your optimal sustainable growth rate. So this is going to increase, right? It's going to go up. This. So it's going to grow up. And so when it go up, means that it would be closer towards the growth rate of the company G. Or what you can do is merge with a cash cow that is growing at a lower rate than optimal growth rate. So I have a question, and maybe most of you all know because you have taken some strategic management course. But what's the meaning of this cash cow, and why would it be growing at a lower rate? Okay, yes, a lot of cash, but much with a cash cow that is growing at a lower. Why does a cash cow have generally growing at a lower rate? Yeah. Okay. Yeah. Right. So typically, yes. So yeah. Right. So typically, a cash cow is yeah. So you're all correct. One with a lot of spare cash, right? But what's important is that they are also more in a mature stage of their growth, right? So they are not in a startup stage, and because of that, then their growth rate is lower. And by merging with this cash cow, you because this cash cow have a lower rate, you will bring the average growth rate down, right? Yeah. Yes, correct. So yeah, thanks for replying. So yeah, all right. Okay. Now, on the flip side, what happens is that the growth rate is less than optimal growth rate. So what in this situation, what happens? It means that the company is actually growing slower than what is the optimal rate they're supposed to grow. Then the question is, what do we do now? So we can distribute the excess cash to the shareholders in the form of increased dividends. So when you increase your dividends, your retention ratio is lesser. Lesser retention ratio means lesser sustainable growth rate. So we are trying to reduce this by distributing the excess cash. Or what we can do is we can purchase a company that's growing a lot, right? So when you purchase a company that's growing a lot, your growth will be more and therefore you'll be closer to the optimal sustainable growth rate. Okay. So this comment is quite important. So no company grows at a constant rate. If we take a long time, we can find an average rate being used to grow every year. So this is an important comment, especially for your assignment, where you need to determine a sustainable growth rate. So find the average growth rate will be important because no company will grow 10% forever, right? So you can find the average growth rate. Okay, so your retention ratio, RR, is equals to what? How do you calculate retention rate? One minus, yes. So one minus payout. So we have more dividends, means payout is higher. When your payout is higher, your retention is lower. Okay. Is it clear? Okay. Thank you. Okay, so we have a simple example here. So these kind of questions can be easily like your MCQ questions in your class test, because these are actually lecture 2 kind of examples. So suppose you estimate the required return for JCPenney stock at 8.8% using the cap M. On examination, you believe there's stable growth. So let me just highlight this first. You believe it's stable growth, right? So stable growth, that means constant, right, at 6%. So calculate the dividend growth model for the value of JCPenney stocks. And the second part is current stock price is 25. So determine whether JCPenney stock is fairly valued, undervalued, or overvalued. Right? So this can be a typical class test kind of question. So in the stable growth, we use the growing perpetuity formula. And what's important is this, right? Let me just highlight this. You believe that the current dividends is this. So current dividend. So what does current dividends means? What's this? Is it D1 or D0? So is it D1 or D0? D0, yeah, right. So it's D0. So recall that your growing perpetuity formula requires D1. So in this case, we have to take D naught, right? 0.5 times the growth, 1 plus G. And then after that, you divide it by R minus G. So this is the value of the JCPenney stock using the growing perpetuity formula. Because this amount is less than 25, right? The market price is 25. Means that what? The market price is more than the intrinsic value of the stock, which is 18.93. And so this means that the stock is overvalued. Questions? Okay. We have one more example here. So let's look at this company. It's a profitable company expected to pay dividend next year. Okay. So is this D1 or D not? D1, you're right. Okay, D1. But because it's depleting a mine property, so this is quite interesting. A mining property, okay, I can share you a little bit later after this example. But so it's a mining property. The best estimate is that the dividends will decline forever at 10%, right? Why does it decline? Because as you mine more, there's less resources, and when there's less resources, then you can distribute less, right? Because you have less revenue, you distribute less. Okay. Rate of return on Efron stocks is 12%. What's the value of the stock? So again, we use our growing perpetuity formula. This time we already am given the D1, right? So just take note, because it's declining means that this is a negative 10%, right? So there is a negative here, and then we calculate that the stock price is 19.32. Okay, so we have one more example here. This is I would say a bit more complex, but it's not too difficult. So ACME Limited had earnings of 15 million. It has 5 million of outstanding share. Okay, it retained an amount of 6 million, and its equity at the beginning of 2008 is 60 million. The earnings are expected to grow at a sustainable growth rate for a long time. So this immediately tells you it's a stable growth. So in a question, they will not tell you this is a stable growth, right? In a standard question, they will just give you hints that earnings are expected to grow at sustainable growth rate, means a stable growth. The risk-free rate is 4%, market risk premium is 7%, and beta is 1.1. Question, market risk premium. Do you still need to remove the risk-free rate from here? So in other words, market risk premium, no, yeah, right. So immediately you can tell, right? So market risk premium is the return on market minus the risk-free rate already, right? So this thing is 7% here. So please be careful, right? So in your class test again, read the question carefully. They will treat you in this kind of ways, right? Okay, very good. So estimate the value of the stock. Okay, so we are given the earnings, we are given the share outstanding, how much do we retain. We can kind of calculate various things, right? Since we are given the earnings, we know we can calculate the earnings per share because we are given number of share, earnings, that's fine. Then we calculate the how much being retained, right? So what's the RR? So the RR, because we know that 6 million is being retained out of the 15 million. So 6 divided by 15 is 40%, the RR. The dividend payout ratio is 1 minus 40%, which is 60%, right? So 60% of the company's revenue will be paid out as dividends. So in this sense, if the earnings per share is $3, so the dividends per share, so if you have one share, you're going to get 1.8. So you take 60% times $3, right? Earnings per share. Okay. Then now we need to use our sustainable growth rate formula using the fundamentals of ROE times RR, right? So how do we calculate ROE from this question? So we are given, so I'm not going to flip back to the question, but you can flip back on your side. We are given that the returns or the income, the revenue is 15 and your equity is 60, right? So your ROE is just 15 divided by 60, which is 25. And with ROE, I can use the G equals to ROE times RR, right? So I take 25% times your RR, 40%, right? To give you 10% here as your sustainable growth rate. I can calculate my cost of equity using my cap M. So this is cap M. And then from here, I know that whatever I calculated here, the dividends per share is D naught. So this is important again. You're almost there, but just um, do not forget that 1.8 is as of D naught, which is now. So you need to multiply by 1 plus G in your growing perpetuity formula. And that's how you get the first one, which is the value of the stock, ACME. Now, the second part of the question is quite interesting because they ask you, what is the value of growth? So it's it might look a bit strange. Huh? How do I calculate value of growth? Now, it's not entirely new, right? Because we fall back on the first slide that we talked about. Remember when they say a stock has no growth? So when a stock has no growth, 100% of the returns are being paid out as dividends, right? What does this mean? It means that all of your your earnings per share tree is going to be paid out as dividends. And when there's no growth, is a perpetuity, right? Present value of perpetuity. So in this sense, we can calculate a situation, the value of the stock when there's no growth using the perpetuity formula of 3, right? 3, which is the earnings per share. That means we pay out 100% as dividends. We pay everything as dividends, right? Divided by the cost of equity, and we get the value of this share. And we just take the value here of the stock that's growing minus the value of the stock that is not growing. Then we get the value of growth. Does anyone understand part B? So part B is important because you notice how the question can be very indirect, right? And they are indirectly kind of testing you. Do you really understand what does it mean by there's no growth? Does everyone understand part B? Okay. Yep, I guess no questions. Looks good. So part B is a very indirect way of testing whether you understand the concept of no growth, meaning 100% is being paid out dividend, and therefore we can use this concept to determine the value of the growth. Okay. Okay, so maybe now is a good time. We'll take a slightly earlier break. As you know, we like to take two, probably by now you know we take two breaks. So let's take a slightly earlier break. We try to come back by maybe 7:08, and then we go into the two-stage model. Okay. If you do have a question, put them on the group chat. We can answer them when we're back. All right, welcome back. How's everyone? Right. Okay. Okay. So let's continue on the two-stage dividend discount model. All right. So we have covered one stage. Now, two-stage, what we're going to see is that the first one is a sudden drop, right? From supernatural GS to GL, right? Growth long term. Now, I think the best way to tackle this is let's look at an example. Okay, so we have a company that dividends growing at 20% for 3 years. So it's going to be at a supernatural rate for 3 years. And it's going to sharply fall to a sustainable long-term growth rate of 8%. We are given that the dividend D naught, which is D0, is 1.8, and the cost of equity is quite nice, this question. They just let you know that it's 11.7. So now let's try to determine the value of this firm using a two-stage simple model, right? Simple two-stage model. So, so I've prepared this slide trying to explain the various steps. So there is a formula, right? We'll see in this slide here. But how I like to do it is let's just understand how it's being done, right? Do not just and not just rely on the formula to mechanically calculate. So the reason why the focus, or I like to focus on using this method of understanding each step, is because in your case, you can actually use Excel. Your final exam is a take-home assignment as well. So it's relatively easy to use Excel and to do these calculations. Now, the formula on the other hand is typically used for your CFA. So those who are interested in doing CFA, you need to memorize the formula because you won't have time to, or you won't really have access to Excel to actually do all these calculations, right? But in the purpose of this course, generally our focus will be to use the Excel method and instead of the formula because you are given the chance to use Excel. Okay, okay, so let's try to go by steps. So the first step, right, is first let's determine the various dividend amount that's going to be paid at the various years, right? So the question they give you that at year zero or D naught is going to be 1.8, and we know that's going to increase 20% supernatural for 3 years, right? So calculate the dividend for first 3 years, supernatural, 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 which means three for these 3 years is going to grow at 20%. Okay. Now we know that on the fourth year it's going to drop to 8%. So then we have this 8% here, right? So the fourth year dividend, this is the amount of dividends that's going to be paid on the fourth year, 3.359. Okay. Any questions on the first two steps? So we have done step one and step two. All right. So step three. So step three is, you know what, I want to discount my first three dividends, right? I'll discount this back to year zero, right? So I'm going to use, some of you might know it as the bunny hop. So hop back, right, to year zero. So this one has 2 hops, this one has 3 hops, right? So these are the calculation here. So I'm going to get the present value of year one dividend, present value of year two dividend, and present value of year three dividend, right? Given by this. This is step three. We have taken step three here. So it gives you the value of the firm based on the dividends of the first 3 years. But that's not all, right? So we need to determine the terminal value. So recall in lecture 2, we have this slide. So I'm just going to jump to lecture 2. You need not jump. I just wanted to quickly show you this slide that I told you was very important. So remember this slide? So remember the three methods, the three cash flow related methods all have this summary slide here, right? And so the last step is always the the terminal value, right? The terminal value here. Why am I not able to do this? Sorry, give me one moment. Yeah, it's the terminal value here. So we're going to calculate the terminal value now. So the terminal value, TV, we'll use the cash flow as of year 4, right? And recall that when we calculate terminal value using the growing perpetuity formula, right? Because remember, our firm is going to grow at a steady 8% forever, right? So we're going to use the growing perpetuity formula. So we use the growing perpetuity formula here, right? Dividends at year 4 discounted by the R minus G, right? But the important thing to take note is that this growing perpetuity formula is as of year 3, because remember, your growing perpetuity is 1 year from today, right? Remember the D naught or your C1, right? So it's as of year 3. Now, this means that you need to still discount your terminal value back to year 3. And how do you do that? You need to do your bunny hop 1, 2, 3 down, which is what is given here. Okay, so this is important. Does everyone understand this? So this calculation is important. Okay, I think everyone's fine, right? If you are shy, you have any questions, you can type them in the chat and we can answer them along the way. Now, having done this present value of the terminal value calculated here, 65.144, I can now calculate my value of the firm where I'm going to add 1, 2, 3, right? 1, 2, 3 plus your terminal value, 65.144, which gives me the value of the firm, 71.387. Okay, so I think that question, right? So it's not really for both year 3 and year 4 with discount back year. Okay, so yes, you're right. So for both year 3 and year 4 we discount back 3 years. But the reason why we do it is different, right? The first reason for discounting the year 3, which is given here, right, is your cash flow, right? Your cash flow for that year. Now, the year 4 one is because of your terminal value, right? Your terminal value and the how you calculate terminal value is using the growing perpetuity formula, right? And the growing perpetuity formula is such that your cash flow is 1 period from today, and in this sense is your year 3, and therefore your growing perpetuity formula is as of year 3, which means that you have to still discount it back 3 years. Okay. So your question is it, just to confirm, your question is it why must multiply this one? Is it this? Okay. So why is because remember your dividends will keep on growing, right? So your dividends for year 1 is 1.8 times 1.2, right? Then for year 2 is 1.2 square, right? For year 3 is cube. So it's cumulative, right? Because your growth is cumulative. So it's keep on growing more and more, right? So for year 4, you have to multiply by 1.2 cube 3 times. Then you multiply by additional 1.08, which is 8%. Right? It's cumulative, the growth. You understand? Yeah. Okay. So what you could do, you can actually just simply take what? You can take 3.11 times 0.1.08. That works as well. Okay, so why can't you do that? Because your year 4, your growth rate will be dropped to 8%. Right? So that's why you can't, yeah. Yeah. Okay. So a simpler method. Okay. So I'm just going to erase all these scribbles. A simpler method is this, right? So you have 1.8 times this, right? So you get this first. You can simply take 2.16 times 1.2 to get this one. And then to get 3.11, you can take 2.592 times 1.2 again, right? So you can do that as well. But why I didn't do that is because I wanted to show you the numbers. Yeah. I wanted to show you how it becomes a square, a cube. Yeah, this is just for illustration. In your Excel, you can just use drag and drop the cell references. That's fine. The formula for cell referencing. Okay. Any other questions? So again, I repeat the terminal value. That's the important part. That is one period from today, meaning that as of will be as of year three, and therefore, so as of year three here, and therefore we need to still discount it back 3 years. So, like you mentioned before, we discussed the how many steps are there? There are 6 steps. We can actually just use the generic formula, right? Where we know GS, we know GL. So long as we know the various things, right? We know what's GS, we know what's GL. We can just plug in the values, and this is a summation, right? We can use this as well, where this component here is basically your dividends, right? Dividends for 3 years. This is just a dividends for 3 years here. And then this thing here is your present value of terminal value, TV. Present value of terminal value. So you can use this formula as well, especially if you do your CFA because you have no Excel, then you need to really use this formula. But since you have Excel, you can just use the Excel. It's easier. Okay. Just for your information, the present value part, which where you discount it, comes from here, right? This is your present value factor, your present value made back. And this factor here is your terminal value, TV, right? Your growing perpetually. Questions? Okay. So I have one more example here. And in this example, this is your, I would say, typical CFA kind of question because you do not really have Excel. So we need to use various formulation, meaning the growing annuity formula. Okay, so let's look at this example here. We have a current dividends D naught, meaning D naught of $2. It grew for next 3 years at 15%. Long-term growth after 3 years, meaning the fourth year onwards, 4, 5, 6, 7, will be 4%. And the required rate of return is 10%. Right? So I'm going to draw a timeline for you just to illustrate to you the various points, right? So 0, 1, 2, 3, 4. Now, we are going to get 15%. So we're going to get 15% for the first 3 years. So I'm just right below here, 15%. 15%. 15% for the first 3 years. On the fourth year onwards, you are going to get a 4% forever, right? Forever. Okay. This doesn't have 15. Let me just write it properly so we don't get confused. Okay, so 15, 15, 15 for the first 3 years, and fourth year, then you drop to 4%. Now, in this scenario, your first 3 years here what you could use is the growing annuity formula. Does everyone still recall what is a growing annuity? Everyone knows? Or finite? Yes, correct. You're right, finite. So that means the cash flow instead of perpetuity, which is forever, your growing annuity is a situation where your cash flow is finite, meaning it can be 3 years, it can be 2 years, it can be 1 year, okay, 1 year no, 2 years, 5 years, 10 years. So there's a finite number of cash flows, right? So if there's a finite number of cash flows, then you are given this growing annuity, right? And we just plug in the values, right? CRG. So long as we have CRG here, CR and G, we plug in the value. So what is our C? Our C is the C is 1 period from today. So it's C times 1 plus G. R is given here, G is here, 15%, right? So I'm going to calculate what's my first 3 years first. First 3 years, present value of the first 3 years. Then what is my T? My T is basically 3 years because we are calculating first 3 years. I get this. So this immediately gives me the present value of my 3 years dividend payment at 15%. Having done that, I need to determine the value of my dividends at year 4. So it means that the $2 times 15% times 3 to the power of 3 times 4%, right? To determine the value of my dividends here, right? This is my dividends. What is the dividends in year 4? Once I do this, then I can again determine the present value of the terminal value, present value of TV. So my terminal value is this, right? Not my terminal. My dividend is here. Right? So not present value or terminal value. Let's determine the terminal value. So we know the dividend is 3.16, and therefore I can determine the terminal value as of year. Sorry, what's happening? I can determine the terminal value as of year 3, right? Year 3, which is the dividend year 4 divided by R minus G, which is the growing perpetuity formula here, R minus G. So this is 52.72 as of year 3. And again, I repeat that we need to do 3 bunny hops back because it's as of year 3. So I need to jump back 1 year, 2 years, 3 years, right? Which is what is happening here. I jump back 3 years where I take this amount, the terminal value divided by 1.1 to the power of 3. So having done this, now I have this figure, 6.56 and 39.61. Basically, I add these two up. This gives me my total valuation. Any questions? So this is just a different method. You can use method one. Method one is really step by step, the six step that we have done here. Or you don't want to do method one, you want to be a bit more advanced, you can do using the growing annuity formula. Okay, I'll pause for a short while. If you have any questions, feel free to put them on the group chat. We will okay for now. Hope this is clear. Okay. Okay. So no questions. Then let's try to understand some critiques of the two-stage model, right? So two-stage model can't assume a very unrealistic situation where the earnings drop from a high rate to a sustainable growth rate overnight, which we already talked about how it's not really realistic. So perhaps there should be a linear decline instead. So a linear decline, and therefore we can use a H model, which is the second method of the two-stage, right? And we're going to talk about it in the next few slides. We assume that the dividend payout and risk remains the same. So in this sense, this dividend payout and risk is present in both the simple two-stage as well as the H model. And so to tackle this issue of a very flat payout, what do we have to do? Then we have to rely on this method, which is I would like to term it the base method, the foundation method, where we determine the cash flow for each year, year by year, year by year, determine the present value year by year, right? So we need to use the fundamental method. And in this fundamental method, we can alter the dividend payout ratio, right, based on the year, because we're not using any formulas, we're just using the cash flows, determine the cash flow. So by just determine the cash flow, we can use different payout ratio to get the cash flows per year. One more critique is in the questions, they give you the assumption of the number of supernatural growth years, right? But imagine you are doing a valuation now for your GPA. The question is, so how many years do I assume that it's going to be a supernatural growth? Do I expect it to be 1 year, 2 years, 5 years, right? So the question is, how do you determine this? This is where I hope you can link back to lecture one. Recall that lecture one, we are talking very extensively about all the various qualitative frameworks. So we need to use the qualitative analysis, economic analysis, qualitative frameworks to help you justify the number of years of growth. Okay, this is important. So I hope you can see that now we are linking it back to lecture one, where we need to provide justification to the number of years of high growth, let's say in your assignments, using lecture one's framework. Okay, of course, there's difficulty in it because again, valuation is more of an art than a science, right? Everyone can value things the same company differently, and in this sense, because of the various assumptions that you use, so things will be very different. But that kind of distinguish a good person, a good valuer versus one that is just starting out his career in valuation. All right. So let's move on to a H model. So recall that H model basically is this, right? There is a linear decline slowly. So what's important is that it's important to know that a H model is an approximation formula. So this is not a perfect way. It's not a accurate model. It's a very good approximation, right? And how do we determine a H model is that during this year of decline here, right? During this year of linear decline, we're going to assume almost like this area of triangle. Anyone know what is the formula for area of triangle? What's the formula for area of a triangle? Half base times height, you're right. So half base height, right? Half BH. Thank you, thank you. So we're going to almost estimate this half BH, which is why in our formula, which we'll see in the next page, there is this H. And this H is given by number of years to reach sustainable growth rate divided by half. And what is this means? This is T, right? So this is T. So number of years. So now this is number of years, right? So this is your number of years, and your half is here, right? So half number of years is the base, and we are going to use the height here. Later you'll see in the next slide, we will have the height. So let's put in the back of your mind that this is an approximation formula, and we're actually using the area of the triangle to approximate. Okay, we'll see that in the next page. All right. Um, Again, there's some assumptions here. The dividend payout ratio remains constant in both stages. So in this H model, because we are going to purely use an approximation formula, we are going to use a formula, meaning that we're not going to use the fundamental method. Meaning what? We're not going to use this method here, the fundamental. We are straight away, the H formula, because it's called H formula, it is a formula like this. It's an actual formula, right? So we're not going to use approximation. We're not going to use the fundamental method, meaning that it assumes the dividend payout ratio is going to remain the same. Again, another assumption is that the H model only works if H is small. What does it mean H is small? It means that the number of years between this and the distance between it is small. It cannot be like the H formula is like 10 years, right? Because your day approximation becomes very inaccurate already. Okay, great. I hope you have this area of triangle in your back of your mind. Let's look at the formula now. Okay, so the H formula might look complex, but let's dissect it. Again, with the idea of area of a triangle in the back of your mind. Okay, so the first step of the H model, which is, I want to look at this one here. The first step is what? We're going to determine the area of the rectangle where, can you see what's this formula? This is actually a growing perpetuity from year zero. Can you see a growing perpetuity? D naught times 1 plus G divided by R minus G, right? So basically what am I calculating my first formula? I'm calculating this area under this rectangle. So area of rectangle. Again, I highlight to you, this is the area I'm calculating for in the first formula, right? Which is the growing perpetuity formula. Now, in the second formula is the area of your triangle, which is your supernatural growth, where again, I want to highlight that H is given by number of years, meaning T divided by 2, right? Number of years divided by 2. Can you see that I put half BH, right? Half base times height. Can you see that your H, your base, okay, let's say this is base, let's say this is base B and this is H, right? So this half BH, your base is here, right? B, the number of years, right? Which is given by this number of years to reach the sustainable growth rate, B. And what's your H? Your H is GS minus GL. Can you all see that? Your H is GS minus GL, which is given by this GS minus GL. Everyone gets that? Yeah. Okay. So in this sense, then your this part here is just your discount factor and all those things, right? Kind of, right? So I'm trying to break this down for you so that you do not just purely memorize the formula, right? Yes, you can purely memorize. You can just plug in the value. You will see in just a bit the next slide that it's super easy. You just memorize the formula, you plug it in. But I hope that by trying to dissect it in a graphical way, you can kind of understand where the formula is coming from, right? The area of rectangle, area of triangle. Okay. In case you feel that this does too much work, you don't want to kind of really understand so much, you just want to memorize the formula, no problem. You can just memorize this, right? This is the formula. And what is H? H is this number of years to reach sustainable growth rate divided by 2. And if you memorize the formula, you will for sure get the right answer, right? Okay, if you have no questions, I'll move on to this example here. This example looks very long, looks very tough, but the working is super easy. If you memorize the formula, you can write the answer in less than 5 minutes. Okay, so it depends because as you know, your ECA is a take-home assignment, right? And this is lecture 3, which is not covered in your class test. And your class test is an open book. So in a sense, you don't really need a formula sheet, but for your CFA, so I know some of you are taking the CFA. For your CFA, you need to memorize the formula. Or even if the CFA somehow give you the formula, you need to memorize it because usually CFA is a time test, right? It's about how fast you can do a question. Then you can pass because usually time is the factor for CFA. Okay. All right, so let's look at this example here. So again, so FRM similar, but I don't think you'll do valuation because there's financial risk, right? I don't think there's a valuation component. I do not think so. Because the CFA is really about valuation. I don't think for FRM there's valuation. Yeah. Okay. So let's take an example again. ACME Limited has earnings of 5 million shares. Kind of the same thing. Earnings is growing at 20% for 5 years. Okay, so this is your supernatural growth. So this is your GS. Is expected to grow a sustainable growth rate of 8%. So this is your GL from 5 years onwards, or the growth rate will uh, linearly decline every year from the current 20% to 8%. So they are trying to emphasize to you this is going to be a two-stage hedge model. All right. The dividend payout is 60% and continues to be constant. Okay, this is part of our assumption in order to use this hedge model approximation formula. That will give you the same thing, risk-free rate, market risk premium 7%, estimated beta 1.1. Calculate the value of this stock. Okay, so for me, how I like to do it is to do this, draw a graph, right? Draw what is this trying to say? So 20% at supernatural here and 8% at growth long term. And this will only last for 5 years. So I always like to draw a graph so you can easily visualize. All right. So now we want to calculate first the EPS again. So same thing because we want to do dividends per share, right? So you can calculate the value per share. Okay. So then we determine the payout ratio. We determine the dividend per share. So this is exactly the same as earlier example, 1.8. Is no different from the example earlier. Determine the cost of equity, 11.7, exactly the same. Now, remember I said if you don't want to understand the formula, just memorize it. You just need to memorize this formula here and you plug in the values, right? D naught, what's D naught? 1.8 is the D naught. You plug in the 1 plus GL, and GL is your growth normal, right? Your growth normal is 8%, right? GL plus D naught again, and H, remember H is what? Number of years, which is 5 years divided by 2, right? Take number of years to go from supernatural to long term, divide by 2. H is just that, right? 5 divided by 2. Then you take your GS, supernatural growth, minus your growth normal, growth long term. And then you take your, now you can't see anything. Now you take your R minus GL, right? Your growth long term, which is here. And voila, that's all. You get your 67.14. And that's your answer, right? So you see how simple your H model is because it's an approximation formula. You just plug the values in, that's all. You get your answer. Questions? Again, I repeat for your H. So some people maybe miss this point. H is basically what? H, I'm going to flip back here just to emphasize again what is H. H is your number of years to reach sustainable growth rate divided by 2, right? And this 2 is always there, right? It doesn't change. It's always divided by 2. So number of years to reach sustainable growth rate. So we have 5 years in this example here, right? 5 years. 5 years. So I just take 5 divided by 2, right? 2 is always there because of our triangle formula, half base, half height, etc. Right? So let's look at some strengths and weaknesses of our dividend growth model. So dividend growth model is useful, of course, if it's a stable growth, the company is paying a stable dividend amount or dividend payout ratio. Um, Therefore, it might actually be quite good for kind of broad index, equity index. It's quite simple. You just rely on the payout ratio, the growth, sustainable growth rate. So it's relatively simple. So you'll see in the next lecture when we talk about the free cash flow to firm, free cash flow to equity, that becomes quite complex, right? Because there are various formulas. But this one a bit simpler. It provides an approach to estimate the expected returns given efficient price. So for basically um, if we have a dividend paying company, we can use this to estimate the expected returns. Okay. Some weaknesses. If you notice, they are actually very sensitive to the assumed growth rate, right? Because of our TV terminal value, right? You will see that I'm just going to show you that most of our value. Okay, so I'm just going to flip back to the last slide. So if you notice something interesting, right? So most of our value comes, oops, no, this one is your present value of terminal value, which is this, right? 39.61. So can you see that most of our value comes from this instead of our dividends? So because our terminal value is determined by a growing perpetuity, it means that the growth rate is going to determine the large portion of our valuation. Of course, if it's um, non-dividend paying stocks, you can't use this method. If the growth is very unstable, again, you cannot use this method because like things like H model is approximation model. So if your thing keep on changing, then you can't use the H model, obviously. Um, that is not applicable for the rate of return higher, growth rate higher than the required rate of return. Remember the assumption is what? The assumption is R minus G, right? So your G cannot be higher than your R because then it becomes a negative number. Becomes a negative number. Negative denominator, which doesn't work. There are some uh, valuation key points to take note of. Your earnings can be negative because if you have negative earnings, typically the firm do not distribute any dividends anymore, meaning that you cannot use the dividend discount model. Of course, you must use a company must pay dividends in order to use this model. Um, and we want in the model, like what we mentioned earlier, there must be a stable payout ratio, meaning that there must be a consistent relationship between the company profitability and the dividend payout. So it cannot be very haphazard. One year give 30% payout, next year give 80% when there's a loss, then it'll go back to 10% when there's a large net profit, right? A dividend discount model is good whenever it's hard to determine the free cash flows. meaning that you can't use the FCFF or FCFE. So in case you really do want to use the dividend discount model for a non-dividend paying company, we still can use it by using, let's say, the industry average payout ratio. Then we estimate the amount and timing based on that. We can use several alternative also. We can use the free cash flow or residual income model or relative valuation, which is what we're going to cover in the next lecture for free cash flow model and the relative valuation in lecture 6. Okay, I have a question under the weakness not applicable when growth rate is higher than the rate of return. The required rate of return is not the market risk premium. Your required rate of return is your CAPM return. Is your CAPM, CAPM. So it's your RE, right? So it's your required rate of return for equity. So in your growing perpetuity formula, remember is D1 divided by R minus G. Yeah, so what is this required rate of return is this one, your R. So your G cannot be bigger than your R, if not your value become negative, your denominator. So your required rate of return is your RE or your value after cap M, using cap M to calculate. Okay, this is just a repeat. When is it suitable when the company is distributing dividends? Dividends relate to company profitability, meaning that there's some correlation between profitability and dividends. It's not like super crazy where the company is a loss position might give a lot of dividends, and then when it's gain, it's not going to give dividends, meaning there's no dividend policy. Then it doesn't work for dividend discount model. For valuing minority stake of a company, this one recall we discussed what is this minority stake. Anyone recall what is this minority stake discussion we had last lecture? Why is the dividend discount model a good way to value minority stakes? Anyone like give a try? Give it a try, even if you are not correct. Good attempt. Something about the share holding structure. Yeah, right. Something like that. So maybe it's a bit it was it's a bit complex, okay? For minority stake. So yeah, I think I thought about ST engineering. So something about no influence of management policy. Yes, you're right. So something about that, right? So what again, let's try to recap again what is minority stake. So what's a minority stake? So remember something like this, right? We I think last lecture we talked about HoldCo, holding company or HoldCo. He owns like a subsidiary called sub, right? Let's say called sub. And this owns a sub, let's say 80%, owns 80%, right? Meaning that actually 20% is owned by somebody else, right? And we call it MS. We don't know what that minority stake. And they need not own 20%. It can be 5%, 5%, 5%, 5%, right? 4, 5%. So it can be this one can be 4 times 5%, something like that, right? Where MS equals to minority stake. Now, so what happens is that in our financials of the whole here, you record 100% of the gains, the asset, everything is recorded there, right? In the balance sheet, in the profit and loss account. Because it will have a consolidation based on accounting books. But then, if you think about it carefully, maybe in a more finance sense, it's not fair, right? The company, the whole company here does not really own 100%, because 20%, this one, is owned by somebody else, right? Somebody minority stake here, right? Where there are four so-called shareholders of 5%, right? So then the thing is, for this company here, MS, or not company, minority stakes MS, what's important to them? Because for them, they are only 5%, right? So for this company with only 5%, what's important to them is just maybe the dividend payment, right? They're not so interested about, remember the last lecture, we're comparing it with free cash flow to firm, free cash flow to equity. They're not so concerned about that. Maybe they're just interested in how much money I get at the end of each year, right? And therefore it is the dividends discount model, which is why when we value minority stake, we can use the dividend discount model. Because remember, your minority stake, they're not part of equity, right? It's being always categorized separately from the equity of the company and the non-controlling interests, NCI. Yes, so they do have shareholder rights, but just that they are the minority. So a best way to think about it is, for example, today you go and buy Apple shares, you buy one Apple share, you'll be considered a minority stake. So do you have shareholder rights? Yes, you can vote with one share, but chances are your vote is useless, right? Compared to the majority stake. We have one example here, a simple example, right? We have two companies. So let's look at these two companies, OXY and HRL. So the question is, which is suitable for using a dividend discount model? And immediately, what should we look at? Let's look at the payout ratio versus the earnings, and payout ratio versus the earnings. So the question is, which one do you think is suitable? Oh, I immediately answer. You're right. So HRL, right? There is somewhat a consistent payout ratio. Yes, there are fluctuations, which is expected, but it's not as crazy, right? Can you see here? 800%, and then suddenly nothing because it's a negative. And then when it's earning more money, it suddenly dropped to what? 70%, 76% only. So it's a bit, yeah, it's too volatile to use the dividend discount model for OXY. Maybe you can use the free cash flow models. Okay. So that's all we have for the lecture. Remember, I was saying that for the first 2 hours, we'll do the lecture, and then the next hour, we'll do the case study. Right? So before we jump to the case study, there are some self-review questions, examples here. So again, if you want to practice for the class test, which is actually towards the end of the course, please refer to these examples here. They are very good examples for you to kind of solidify your understanding on the dividend discount model. And I've tried to provide you with all the workout solutions. So you can see that even for question 3, there's solutions here, but I've done the working for you as well. So that to provide you the solutions so that you can practice on your own. So do take advantage of this. Yeah, this. So I updated the solutions quite recently, like for solution 12, like question 12, it's quite a long question. I did the full working for you. So encourage you to give it a try um, in preparation, right, for your class test. Even though your class test is not covering lecture 3, but lecture 3 again, I did mention lecture 2 is just an overview of what is going to cover in lecture 3 and 4, right? So potentially what can come out in your class test can be a simpler version of these self-review questions. Questions before we take a short break? No. Okay. So all good. Okay. So let's take a break, and then if we do have questions, do write them in the chat, and we'll answer them before we start the case. So in the meantime, for those that do not need a break, please download the Nike case, right, from our tutorial site, and we'll run through it in the last part of today's lecture. Okay, we'll take a quick 10 minutes break. We'll be back at around 9:10. Welcome back. Uh, so hope everyone's doing well. So let's move on to the last part of today's lecture. Let's go through this case study, right? So this is a very interesting case study. So some background on this case study, it was written a while back, 2021. So I know some of you all are doing some investing already. You will notice that in this question, Nike stock price is actually double of what the stock price is today. So if you were an investor in 2021, you will have half your investment by now because the stock price has fell. Um, yeah, Nike hasn't been doing too well because there are a lot of brands like Chinese brands, Skechers, different brands that are competing for Nike's market share. So unfortunately, Nike is no longer the top brand. And over the years, they have actually made quite a few poor decision choices. One of them is to actually remove their products from more, say, departmental stores, um, kind of, I think, consolidating their retail presence, which has not been positive for their growth. Um, and they're still struggling, right, to capture the target market, especially as people move towards different styles, maybe less of the sneakers type of style. But Nike's focus on sneakers, right? So they have a difficulty to pivot that in a different direction. Um, Anyone a big fan of Nike here? Okay, that's good. I are you into the Air Jordans line or is it the running shoe line? What you're into? Jordans. Yeah, right. That's a classic Air Jordans running shoe. Okay. Yeah, in fact I just got the a running shoe. I think it's the Vaporfly. Anyone use the Vaporfly? I think white Jordans as well. Um, uh, yeah, the one with the carbon plate that helps you run a bit better because you spring on the ground a bit more. Of course, you can't use it for the gym and all. It's just like purely outdoor. Hoka's, yeah. Hoka is another one that is a competitor of Nike. Um, yeah. Yes, the carbon plate is banned in marathon, but I guess if you join marathon and you just run it for fun, right? You're not a competitive runner, you're not trying to get the first three positions, you can still wear your cable fly, right? Okay, so actually I wanted to show you all something, just I forgotten about it. Um, I talked about the gold mining, right? PT Archie. So today I was looking at this company. As you know, I do credit valuation. So I was looking at this company who does gold mining in Indonesia. So their focus is quite interesting because they do pure play gold mine. So what does this mean is that they do not focus on any other mining metals or non-ferrous metals other than gold, right? So most other companies, maybe you might have heard of this Merdeka, right? This other company called Merdeka or PT Aman, where they actually do nickel mining, copper mining in Indonesia as well, in addition to gold. But this company called Achi only does gold, right? So why I want to bring this topic up because this is directly relating to valuation. So why I actually like the way they structure this report. So this report was done by Bank Mandiri. the biggest Indonesian bank, and this is the Securities department. So they do valuation. If you do have time, encourage you to have a look at this. You just type PT Archis Indonesia Mandiri. You should be able to find this. This is on the public web. So why I want to highlight this report is as you do your GPA, right, you see that this report uses the what you kind of understand about the frameworks we talk about, particularly looking at the qualitative, then the quantitative, very nicely, right? So they provide lots of figures explaining their forecast. So these are all forecasts, right? December 26, December 27. So they do some valuation reports. Oh, thanks for sharing, right? So and they see there's some investment theses. So this is a very good way to structure your report. And this is very up to date, right? So this report was done in September 25. And if it's good enough for the industry, it's good enough for school as well, right? So I just want to highlight. So there's a lot of content here, quite interesting. You can take 1 hour to read it, but I'm not going to go through. But for me, I really like the format of this report. So then you see it has a company profile, right? So at the start, it really talks about, see, there's this thing about cash flow, the positive free cash flow. So there's some form of financial analysis using free cash flow because you're using your cash flow models, right? Then they talk about corporate structure. We recall in lecture one, we highlight how important it is to talk about the management team, the structure of the company. Remember, I think I mentioned also something about ST having golden share, that kind of thing. So they really bring in all the topics or all the key elements of valuation in. They talk about some projects, but this is very specific to mining companies. Talk about projects. You might not need to do so because your company is not a mining company. um, Reserve, sizable reserve. So they did talk about some let's see, can you see board of directors? So they focus also a bit on the management team because the management team is part of how the company is going to grow, right? So this is an important part as well. Um, Now, okay, this is the part I like. So valuation and forecast. Can you see that they explain to you what do they use in assumptions in their valuation? And I hope you notice something. Do you notice that a good portion, remember I mentioned almost 40% of your report is very qualitative. Can you see strategic positioning? So everything is more qualitative. It's on your valuation model really only comes in the last part of the report, which is not a lot. It's just one page here like this, right? So your one page of your report, your valuation is like this. I like this figure 49. So figure 49 here, you will see this in Nike as well. So that's how I'm going to link back to Nike. You'll see this way of presenting your valuation. And we'll do this particularly for the WACC Nike, the same kind of formatting. Um, and then this is the part that I thought was amazing, where you do a sanity check in terms of your valuation. So this is where you are going to use your lecture six knowledge on relative valuation to actually check, hey, okay, I've done my DCF model, my discounted cash flow model. Am I close to the valuation based on relative valuation or based on certain other parameters, right? Do a sanity check in terms of your valuation to ensure that you are actually on the right track. So I really like this component. Peer comparison, very important, peer comparison. So this is something you need to do as well, to compare their peers. And then this is your industry overview, right? So this is where all your frameworks come in, where are they in the cycle, etc. Right. So this is a very extensive report. Key risk factors, you see they will talk about this. Yeah. So I just want to highlight this to you. And then the last page, this is more just an overview of the balance sheet. If you can do something like this, so just a screenshot of what you have done, what figures you have used in your calculation in a very simple format, right? So just focus on key items like revenue, gross profit, net profit, EBITDA. So you can really use this template as a good reference in terms of putting the numbers here. So A is actual, F is forecast, right? So they did some forecasts as well, 3 years of forecast. Typically, forecast we recommend 3 to 5 years, and actual at least 3 years. Right? Yeah, so DCF is a discounted cash flow model. Yeah, right, discounted cash flow. And the discounted cash flow model includes the dividend discount model we talk about today, as well as in the next lecture, we're going to look at the free cash flow to firm and free cash flow to equity. Right. Okay, that's all. So I just want to highlight this report which I read today and I felt was amazing. A good foundation in terms of really what the industry is looking at in terms of valuation report. So not just pure academic, right? Something that you learn in school and you never use it in the industry. Let's say if you're interested in valuation, and you are like this lady here, not sure what's her name. So there are 3 ladies here. So yeah. Sorry, just give me a moment. Sorry. Okay. So if you're like this lady here, and want to be a equity analyst, for a bank, you can kind of expect the type of reports to be like this. So right. So if you can structure a report around these parameters in terms of the description, um, that'll be great, right? So we know that you are working towards something that is used in the industry rather than just a pure academic exercise. All right. In case you have questions on this, you can write on the group chat or drop me an email. Let's just go back to the Nike case. So the Nike case, this is a bit more of trying to, you know, do they have provide reference in the real world? What does it mean? Are you talking about industry analysis? Like, what do you mean in a reference to the real world? So if you are referring to like actual figures, actual financials, yes, they provide reference to those in the real world. Like, ah, okay, so like actually, would they source information from somewhere or so that they, yeah, so typically they will try to provide sources. Of course, um, let me see, this one they do not tell you where the sources is because some of the like citations, right? So, okay, so I guess that's where it's going to be slightly different in your academic exercise. You do have to provide some citations, but at certain level, those citations kind of only relate more to your qualitative components, right? Your quantitative components, maybe the assumptions, you can reference some things, but at certain level, when you start doing your cash flow analysis, there's nothing to reference, right? Because that is um, your own valuation that you're doing, right? So at certain level, your at certain stage, your quantitative component no longer have any references. But for your qualitative, when you do your various SWOT analysis, etc., yeah, those you have to do some reference. In this report, they don't, because typically this kind of equity report, there are some proprietary way they get information. They do not want to disclose their sources um, to the public. Yeah. But yes, so in your case, for the academic exercise, you do have to provide your citations um, as required. Okay, thanks for the question. Any other questions? Citations. So on the topic of citations, just be careful about your AI score. I think the school has been As also drop a reminder to everybody. So just be very careful on that. You do not want to be flat. So what I saw previously that some students used the Grammarly. So Grammarly, I believe everyone knows Grammarly, right? Where you it's a AI software where it helps to improve your sentence structure. And unfortunately, when you use Grammarly, the AI score picks it up as 100% AI score. Um, Normally, if you explain it, you can provide evidence that it's just Grammarly. The school is quite sympathetic, so they will do um, not penalize you unnecessarily. But of course, then you have to do additional work, right? You have to prove that it's very Grammarly and all those things, which then you might be stressed with other modules, and then this adds to your own stress. So just be very careful when you use the AI. Okay, so let's go to case study. So you are equity analyst in this local firm. As part of your summer internship, the program rolled out by your firm, you are tasked to guide your fellow intern MD in determining the cost of capital, i.e., what we're looking at is the WACC, right, cost of capital for Nike. So ND, which is your fellow intern, um, immediately gathered information he thought was useful in his analysis and provided a estimate of the cost of equity. He explains the assumptions and approaches below, right? So sorry, let me just erase this. So you notice that this is basically the annual report. They in this question, in this case, they extracted annual report for you. I just want to jump to the question first, right? So question is just two lines here. So there are four parts to the steps that Andy has taken, right? So there are four parts, and for each part, critically appraise Andy's method. So you're supposed to see whether Andy is doing the right thing, right? Or he's doing the wrong thing. Some of it might be right, some might be wrong. So you're supposed to determine whether you're right or wrong in his approach, with his calculations, explain your choice, take any assumptions used. You're supposed to use data from FactSet. So FactSet is similar to Bloomberg. Previously, I think the school was subscribed to FactSet, but I think they stopped. So now is Refinitiv. So you can use Refinitiv as well. Nike is a listed company, so information will be available there. Okay. All right, so let's tackle each portion, the four parts, right? Let's tackle part one, each part by each part. Okay, so we are given the financials here. Okay, let's look at some things. We are given things like your earnings per share, your income. All these are in US dollar millions. Okay, let's share data. So some interesting thing I want to focus on. Okay, you're given some of your balance sheet um, liabilities, right? Balance sheet, equity amount on the balance sheet. Okay, these are all balance sheet figures. Sorry, equity wasn't there. Equity is here, right? Sorry, equity. But these are not your market value, your balance sheet. What else? You're given the US Treasury yield, various years, right? 3 months to 30 years, sourced from Bloomberg. Okay. Okay, so what is Andy doing now? So the first part Andy did, he wants to determine the methodology of calculating the cost of capital. So this is what Andy writes. So since Nike is funded by both debt and equity, I use the WACC method, right? Based on the latest consolidated balance sheet, debt and equity made up 42 and 58% of the total balance sheet for May 21. And he did the calculations for you. He's showing you that the total debt here, given by for this year, makes up 42% of the total balance sheet, and equity makes up 58%. So, question, what will be your comments for this? The first part of what Andy did. Is he doing it rightly? Is he not doing correctly? What should he have done? Okay, yeah, I like that comment. Historical figure use, which is not correct, right? We understand that when determining the weight of your debt and weight of equity, please use the market value of your equity. For your debt, try to use market value, but for things like bank loan, you should use the book value, right? Your bank loan doesn't really change in terms of the market value. Okay. Important thing to take note is make sure there is no preferred shares. In this case, there's no preferred shares, so that's fine. So I'm just going to jump to the suggested case solution. So for part one, right, methodology of calculating cost of capital, Andy has used the historical debt to equity figures, right? They do not incorporate the forward looking, so it's not so good. Remember, at WACC must always use the forward looking market value. However, it's worth noting that so for most equity analysts, they do tend to use the balance sheet figure if they cannot obtain market value. However, this is Nike is a listed company, so we can actually determine the market value of debt. So in this example here, so for those who do have FATSET and is completed using FATSET, you can use FATSET for your GBA as well. All right. So in this sense, we are given the balance sheet figure here. These are the balance sheet figure of the debt. I think Nike, most of their debts are in bonds and notes, which is why we can use the price times the balance sheet amount to give you market value. So this component here, market value of that, was added by me, right? So in your extraction of your numbers in from Bloomberg or from Refinitiv or in this case FactSet, you will not be given this figure, right? So you just take you do the multiplication. So balance sheet amount times the price, right, to get your market value of that. So your market value of that, you sum it up to give you, so the summation of your market value of that is this, 9400. Now then the market value of equity on the other hand, your market value of equity is what? Your market value of equity on the balance sheet is given number of shares of this. Your current market price is 122. Like I mentioned earlier, if you invested in Nike in 2021, you have made a 50% loss, fortunately, because the company isn't doing well. But using the latest price, 122, you multiply by number of shares, you get the market value of the equity. And then you calculate the weight of your debt and weight of equity. Can you immediately see what a big difference it is? 6% debt, 94% equity versus your and this calculation, which is so far off, right? Based on your balance sheet figure. So please be very careful when you do your GBA on this point, because it's going to make a big difference to your calculation of your WACC. Any questions, comments for part one? Okay, so this one is using FATSET. So previously the school has access to FATSET. I do not know whether you do have access to FATSET. However, you can use Refinitiv, which I understand that all of you should have access to, or Bloomberg. I think if you go to a library, you might have access to Bloomberg. So you can use both Bloomberg or Refinitiv. You should get the figures that are good as well. Yes, so you should, because so you're doing a valuation, right? Whenever you do a valuation, you should use the current figures. Unless it's things like, remember we discussed, oh, you might have some bank debt. Bank debt, you might not need to use current figures, right? Because those are fixed amount. You can use the balance sheet figures. So there are many considerations. Hopefully, when you do your GPA, maybe you have a few people doing the qualitative, a few doing your quantitative, and do a double check, right? But remember earlier I mentioned about the PT Archie, where I commented that I like this component about sanity check. So in this case study, we also do a sanity check at the end. So we'll see how the sanity check is done. Okay, now, cost of debt. So this is what Andy did. So cost of debt, to estimate the cost of debt, I've used the total average interest expense for the 3 years divided by total long-term debt for debt balance for the 2 years. The rate was close to the average 12 months and 2 years US Treasury yield, which is in line with my forecast horizon. Given that given the debt is tax deductible, I adjusted my cost of debt using the US statutory um, tax rate of flat 21% under the Tax Cut and Job Act of 2017. My cost of debt comes out to be 1.12. So Andy nicely provided you the calculation. So he's show you the interest expense for the 3 years, total interest expense, and then total debt for the 2 years divided by this. You get cost of debt. Is this right or wrong? Is he on the right track? Okay, it's wrong, but different industry, different rate. I'm not sure what does that mean. So it's wrong, that's right. You never use latest rate. Okay. So I can see that most of you all know that it's a bit off, right? It's wrong. So it's wrong, first of all, because why are you taking interest expense divided by total debt? So again, you are using your book value numbers, right? Which is not your market value. Then it's a bit off. Then maybe you will have further questions. Why you use 3 years interest expense and then 2 years of debt? Does that make sense? It's a bit funny, right? Why is it different? 3 years, 2 years. Not really justifiable. And this rate is close to the 12 months and 2 years US Treasury. So what's the 12 months and 2 years? So 12 months and 2 years. So these two, the Treasury yield. Now, what is the US Treasury yield? What is this figure trying to give you actually? Risk-free rate, you're right. So US Treasury is the risk-free rate. So it is very strange that your cost of debt is close to the risk-free rate. You know that debt must cost more than risk-free rate, right? If not, then they might as well just borrow from the government. So it's a bit wrong already. It's close. So this comment is a bit, you should give you a red light, like, hey, this is a bit off. Okay, that's something that you should kind of like, oh, okay, this is a bit off. Now, let's look at the tax deductible first. So yes, we know that are tax deductible. Is it okay to use the US statutory flat of 21%. So this one tax is always a bit tricky, because uh, so those of you who are accounting majors, which I'm not sure, maybe there's one or two of you, you know that tax is a whole topic altogether for accounting, right? It's quite complex. The long and short is it's not correct to use the statutory tax rate, because in the US, tax is collected at the federal level, which I believe is 21%, as well as the state level, right? On top of that, so tax is a bit complex. So on top of that, most of the time, companies receive some form of um, deductibility for their tax, meaning that they get some offset. So I know some of you are already working. So you know that, let's say if you have a kid, if you're married, you can get some income tax, personal income tax offset, right? If you stay in a HDB versus a private property, you get some offsets as well. If you are a male serving the nation or doing national service, reservists, for example, you also get some tax offsets, right? Deductibles. So similarly for companies, they do have such deductibles, and therefore the deductibles can actually reduce your tax significantly, right? So that in mind, you know that the interest expense is a bit off, the tax is also off, the rate of the interest expense being close to the risk-free rate also a bit funny, right? So let's look at some of the kind of the solutions they provide to you. So cost of debt should be determined using the yield to maturity. So I hope you recall there are three methods that we taught you on how you determine the cost of debt. They use the yield to maturity method. Again, I want to highlight that you can use a variety of each method, not use just one. You can use the average or weighted average of the two or three. Okay. Note that, so there's just some additional comments here, right? Because it's more for learning. So it's note that firms have long-term with long-term straight bonds are widely traded in the liquid market. So in this case, they want to use this particular one, which is the most recent traded long-term bond, which is this bond called 65410 AM5. So in this 65410 AM5, these are the parameters given in the is that I think it's here. Yeah, it's here. So it is here, 6 5 AM5. So it's this one. Oh, sorry. This one here. So this is the most recently, at the point in time, of course, issued bond. So we use the most recent bond. The yield to maturity here actually is given at this 3.6, but then we want to be a bit more analytical. So we actually did a calculation or based on the yield to maturity given by the data provided in FactSet. We calculated that the yield to maturity is actually 3.59%, which is actually very close to the 3.6% calculated in FactSet, right? Can you see here? So the figures are all collected from here. So coupon rate, all this. So balance, price, there's a PV, right? So the yield to maturity of 3.6 actually quite similar to what we calculate of 3.59. So we know that we are actually kind of in the right track of our determination of cost of debt. So we use the most recent, of course, because we are in the camp of valuation, right? We want to know what's the latest cost of debt for the firm, which is why we use the recent one, not the one that is issued 12 years ago, right? Again, this is some prices that is being determined directly from FactSet. So we see that the yield to maturity here is 3.6, which is what we have calculated 3.59. So we know we are quite close to the values created. There are many other parameters, but they're not so interesting to us. In terms of the tax rate, so the 21% under the Tax Job Cut Act, so that one is um, the federal rate. Okay, so in the discussion, we did mention that we should use the marginal tax rate, right? Um, However, we do not really know the marginal tax rate because tax is very complicated. Unless you are a tax analyst, it might be quite difficult to understand this, and this is a US company as well. So what we could do is we can use the effective tax rate based on what's this being disclosed in their financial statement. The effective tax rate is 14% here. So we use the 14%. And for information, let me just show you. Can you see that the federal tax, which is the 21% that was initially proposed, is at a federal level? And then we see some deductions that's happening here, right? Can you see some deductions? So tax can be quite complex, and that's how they will end up at the 14% effective. So in the case that you are unable to determine a marginal tax because of potentially various deductions given to companies, which is quite common, you can click through the annual report, see whether the effective tax is being disclosed, and that can be a tax rate being used for your valuation. Any comments, any question? No? Okay. So I encourage you to read through this example again after today, even though we have went through it. But I really encourage you to read through it again because there is a very informative case study, right? And it will guide you in terms of how you select the parameters for your GBA. Okay. Cost of equity. So what Andy did. So Andy did wanted to calculate cost of equity. My understanding and his understanding the two methods as a cost of equity. He's inclined to use the CAPM model instead of the dividend discount model. Could be appropriate, right? CAPM model is more superior, given it's more superior. Uh, his understanding is that the company plans to hold Nike stock for 10 years. He has used the 30 years bond yield as a risk-free and the arithmetic mean of the historical equity risk premium of 6% as the risk premium. Okay, so equity risk premium 6%. For the beta, he took an average of Nike's 30 years from 30 years ago and found the average beta at 0.8. Okay, so comments. What do you think Andy did right? What do you think Andy did wrong on the cost of equity? So before you look at the answer, you try to think about it yourself. Okay, you're right. So historical 30 years beta seems a bit too extreme. It might be very noisy, right? Why you go back so long? Are you the 30 years ago Nike might be a very different company, right? So just within 2021 to 2026 this year, we see that Nike stock price has changed dramatically. So it is a very different company just within 4 years. Okay, so very good. Any other comments? Yeah, so 30 years treasury yield, so again, might be too long. 10 years might be good. So why 10 years is typically we try to link it to the holding period, right? So the company plan to hold the stock for 10 years. So we try to use 10 years as well. Okay, very good, very good. Um, and there's actually something wrong with the equity risk premium. So this we have not covered really in class per se, but then it's which is why I will cover here in this um, discussion of the case, right? Something is wrong with this arithmetic mean of the equity risk premium. So let's look at what is suggested. Okay, so there's a lot of things to talk about here for cost of equity. So he has correctly identified CAPM model as appropriate method. Uh, so there's some comments about DDM being biased towards the growth factor. That's fine. Okay, we know that already. Okay, using the 30 years yield as a risk-free not appropriate because we should relate it to the investment horizon of 10 years. So perhaps you should use 10 years. Okay. So there are some interesting comments here that we note that the most risk-free, the most risk-free is actually the shortest bond. Anyone know why? Why is the shortest government bond the most risk-free? Yes, you're right. I like that comment. Um, there's unlikely something bad will happen because the duration is shortest, right? Not many things happen in short term. You're right. So the most risk-free, the best one is your short-term rate, your short-term bonds at 3 months. Okay. However, in most valuation, we typically use the 10 years risk-free as the market standard. Yeah, right. Just to note, so not all government bonds are risk-free. Okay. Regarding this equity risk premium, it's not something that we have discussed, but I'd like to use this case to highlight to you something, right? So the arithmetic mean typically means that it's just a normal mean, right? Like the normal average. Now, in as we know, we are in a finance course. Everything in finance is about compounding, right? And so we need to use the geometric mean of the equity risk premium. So what does this mean? Why is there this geometric mean and arithmetic mean? So the idea is that what? So remember your equity risk premium is the premium of the equity, obviously, above the risk-free rate, right? Yeah. So what it means is that this premium changes over the years, which is why in this case, Andy has used a mean, an average. However, he has used arithmetic mean, which do not take into account compounding. So the right way to do it is to take the geometric mean of, let's say, the 10 years horizon that you are looking to invest in to determine the equity risk premium. Okay. Everyone knows the difference between geometric and arithmetic mean, right? Yeah. Okay. Good. Good. So please use geometric mean. So hopefully we'll not see any arithmetic mean in your GBA, right? Um, Again, however, to use the historical equity risk premium can be quite problematic because it does not capture the forward-looking. Um, so this is the part that is important, and I hope that all of you all can use this approach by Professor Aswan Damodaran. So he's one of the legends of corporate finance, right? So um, this Professor Damodaran, his approach is to use um, the sovereign rating, right, based on Moody's, to estimate the default spread that is above the risk-free rate. So first having a default spread. After having this default spread, his approach is to add this default spread to this thing called the matured market premium. And the matured market premium is based on the country, right? To arrive at the equity risk premium. So I provided you the link to his website, and he's very quite rigorous. Till today, he has been updating this market risk premium website equity risk premium in this website. I think the last update was just in January this year. Okay, so please use this website to determine your equity risk premium. If not, um, yeah, you'll face a lot of issues when you do your valuation and you was like, oh, where do I get this equity risk premium? It's so random, right? It's almost like beta. How do you get beta, right? So now we know beta, which we're going to talk in a bit. You must use the regression, right, to determine your beta. Now for this equity risk premium, please use this Double Daran um, website. He's almost the gold standard in terms of determining equity risk premium. Okay, he's the father of corporate finance. All right. Okay. Then what else? Did we talk about the beta? Yeah, the beta, sorry. There's the beta of 30 years, right? So then the beta of 30 years, I think we already kind of discussed about this. It's like, it's a bit too long, the beta, when your holding period is only 10 years. So that is a concern. The best way to do your beta, and if you are really striving for your A plus kind of report, is to run a regression of the stock relative to S&P. So this is the best way to determine the beta um, and determine the slope, which gives you the beta. There's a small comment here, Hyper Studios did not run the regression and should mention it here. So this, because this is a case, right? But it's very different from doing a valuation report. Of course, with a valuation report, it's your own free will, right? There's no one's going to stop you from not doing this beta regression or to do this beta regression. So it's really up to you. This is just a small comment because it's a case. It's not free for all kind of assignment, right? Which is the case for your GPA. Okay, based on information on regression, the implied beta is 0.99. So if you feel that you don't want to do a regression, you can pick the figures from FactSet or Refinitiv, which is given here, right? 5 years, 0.99. Maybe you should use 10 years, but perhaps in this case, FactSet doesn't have 10 years, so you use 5 years. Okay, we use adjusted to take into account some mean reversion of the beta. All right. Questions? So on cost of equity, at the end of the day, you're supposed to calculate cost of equity. So based on your figure, you determine the cost of equity at 6.22. Okay. Last step, WACC. So Andy said, oh, okay, I have gotten all my figures. Now let me calculate the WACC. And he provided, obviously now we know the wrong percentages. He did the wrong determinant of the interest rate, not interest rate, tax rate. And of course, your cost of equity is also a bit off. So his WACC is going to be super wrong compared to FINSET. So, and this WACC is 4.64. So let's see the suggested commentaries. So the calculation of WACC based on whatever you have calculated is actually 6.36. Can you see that immediately the weight factor really contributes a big component of your affecting the WACC. And this calculation is 4 point something versus 6 is a big difference. And if your WACC is such there's such big variance between your actual WACC and the one that you have calculated, your DCF model is going to be way off, right? You're going to make a wrong valuation. So your WACC or your cost of equity is going to be a big and important component of your valuation. Yes. So where is it better? Yes, I think it will be better to use regression because peer comparison, unless you can really find a very close peer, it might be very tough for you to get a very good comparables. A better method, if you really don't want to do the regression or you're not confident of doing the regression, try to take your data from a platform like Refinitiv, a paid platform, not Yahoo Finance, because your Yahoo Finance is going to be terrible in terms of your data. Because data is not an easy calculation because you use a regression method, right? It's not like a formula. So it's not easy for a free platform like Yahoo to give you a good data. Okay. So there's just few last commentaries. I know it's very dense, so I want to also let you have a rest because I know it's CMY. So this last few comments here. Based on calculation, so this is a sanity check, right? Remember we mentioned on PTR3 that it's very good to do a sanity check whether are we close to the WACC and provide some commentaries. So this is important. Provide some commentaries on why your answer varies with a paid platform or varies with I don't know the market, right? So this is an important component here. So in your valuation, you need to do some check. You need to obviously know that your valuation is not perfect, right? So that's why you need to do some checks, right? You need to say, okay, you know what? Let's just compare it with someone that is expert. In this case, the FactSet analyst, who is an expert on this. And we notice that they we have taken the adjusted beta of 0.99. However, the beta used in FactSet is 1.12, and this is the main one causing the firm WACC to be different. Okay. We noted that if we substitute the beta of 0.99 with 1.22, our WACC is 6.55, which is even closer to the FactSet WACC. So what's FactSet WACC? FactSet WACC is 6.51, sorry. So it's still very close, 6.55 versus 6.51. So if we use the FactSet beta, that is the one that's going to affect our WACC calculation and bring it closer to our FactSet WACC. So we do a sanity check in the sense that we identify our mistake, if it's really a mistake, right? It's telling the marker or the reader that you actually know where are you off or where you might be right and FactSet might be wrong, right? So it is really related to the data. Okay. Last but not least, I just want to highlight to you something here. Remember in PTR3, I said there's this table here that did the calculation and presented it very well. So this is the same, but this is done for WACC, right? It's very clear what figures they use. So you can follow such a format because perhaps this is your first time looking at evaluation report, you can follow this format, right? I want to just highlight something to you. The weight of equity, 9.95, sorry, 95. And the weight of the debt, 4.52. I'm just going to show you what we have calculated. So we have calculated 6% for debt and 94 for equity. So we are about there, right? 6%, 4.5%. So we are still off in terms of certain percentage, but we're not too bad. The main thing is really the beta that's driving our variance in terms of the cost of equity, which is 6.73 versus our equity of 6.22. In terms of our cost of debt, so what's our cost of debt? Our cost of debt is 3.1. Okay, 3.1. Our cost of debt, okay, so slightly different, 2.04. Okay, so there's going to be some variance. So it won't be a perfect it's like that's why it's an art, right? It's never going to be perfect. You will not get exact match, even though let's say all the groups do the same company. So just know that there's some difference. There's some preferred shares, but these are very small, so we didn't bother too much. Okay, that's all we have. Any questions? So I hope this case study provide you some good ideas to kickstart your GBA because I think it's a good time to start now. The GBA really requires all group members to contribute because it's quite heavy. I would say this is one of the heaviest GBA. And in order to do well, you really need everyone to contribute. So I really encourage you to start doing it. Can you use credit rating to estimate? Yes, you can use credit rating as well. You can. That is one of the method that was taught. Generally, I encourage you to do a average of two methods if you can. But if you feel that credit rating is good enough, you can just use that as well. Okay. So again, I encourage you to start on the GBA. Would you assign? How will you assign the weights? Yeah. So if you are just using a credit rating versus your due to maturity, maybe it's just better use a simple average, right? So you just take that plus that divided by 2, 50-50, right? Maybe there's no way. But perhaps you have some, because so there's a lot of other research that you can do, right? So maybe you do some research and realize that you can actually use weightage by, I don't know, maybe value of listed bonds versus balance sheet value of bank loans. Maybe it's something like that. Then you do a weightage. I don't, yeah. There can be various methods. Okay. Any other questions? How do you access the platform? So Refinitiv is available for all SUSS students. So do try to reach out, try where you can access the platforms. So Refinitiv, you can access it remotely. You go to your school library database. If you do not have access, at least make sure one of you have access in the group. If you don't have access, you can reach out to the library help desk to request access. So please request it soon because they might take a while sometimes. But I know that at least for all finance students, you should have access to it. And I know some of you all are also working. So if you're working already, you have access to Bloomberg, feel free to use Bloomberg as well. And if not wrong, the library has a Bloomberg terminal in SUSS, so you can use actually those as well. Okay, all right. See some good night. Yes, I know it's a bit late. I already overshot by 10 minutes. Let me just pause the recording.